China has significantly ramped up its de-dollarization strategy, marked by the sale of a record $53.3 billion in U.S. Treasury and agency bonds in the first quarter of 2024. This move reduced China's U.S. Treasury holdings to a 14-year low of approximately $767 billion by March 2024. This aggressive reduction is part of China's broader strategy to diversify its foreign reserves and decrease reliance on U.S. financial instruments, driven by ongoing geopolitical tensions and trade disputes with the United States. The strategic shift is also fueled by China's desire to protect its economy from potential U.S. financial sanctions, which have been increasingly likely given the political frictions over issues like trade policies and Taiwan. To further this goal, China has been diversifying its reserves into commodities such as gold, which now constitutes a higher share of its reserves than at any time since 2015. Saudi Arabia, another BRICS member, also reduced its U.S. debt holdings by $11.1 billion, reflecting a broader opposition within BRICS to U.S. dollar hegemony. This trend is coupled with other BRICS nations like India and the UAE, which have increased their U.S. Treasury holdings, illustrating a complex and varied global response to U.S. financial dominance. Furthermore, the expanded BRICS bloc is exploring alternatives to the U.S.-dominated financial systems. Efforts include developing an alternative to the SWIFT payment system and expanding the BRICS New Development Bank's lending in local currencies, aiming to reduce dependency on the dollar. This push for a multipolar financial world reflects a strategic pivot to enhance financial sovereignty and mitigate the risks associated with over-reliance on the U.S. dollar. Overall, China's significant sell-off of U.S. bonds and the broader de-dollarization efforts by BRICS nations highlight a potential shift in the global financial order, challenging the traditional dominance of the U.S. dollar and reshaping international economic relationships. We would appreciate your support. If you're enjoying our content, please click the like button. Sharing your thoughts and feedback in the comments section would also mean a lot to us. Your engagement helps us grow. Thank you. The decreased demand for U.S. bonds can lead to lower bond prices and higher interest rates due to the inverse relationship between bond prices and yields. When bond prices drop, yields rise to attract new investors. Higher yields mean increased borrowing costs across the economy, impacting various types of loans and credit. Higher interest rates translate to increased borrowing costs for mortgages, auto loans, student loans, and credit cards. As new bonds offer higher yields to stay competitive, existing bonds with lower yields become less attractive, causing their prices to drop further. For consumers, this means higher monthly payments on new loans for homes, cars, and education, which can impact personal finances and reduce consumer spending. As borrowing costs rise, both businesses and individuals may reduce spending and investment, potentially slowing economic growth. Higher interest rates also increase the cost of servicing national debt, which can lead to larger budget deficits or necessitate cuts in other spending areas. Government borrowing costs. Higher interest rates elevate the government's cost of servicing national debt, potentially leading to larger budget deficits or requiring cuts in other spending areas. This strain on the broader economy can impede overall growth, as increased borrowing costs discourage spending and investment from businesses and individuals alike. U.S. dollar devaluation increased interest rates. When China sells a large volume of U.S. bonds, it increases the supply of these bonds in the market. To attract new buyers, the U.S. must offer higher yields, interest rates. Higher interest rates generally make the dollar more attractive to investors seeking better returns on their investments, which can initially support or even strengthen the dollar's value. Market confidence and volatility. However, the large-scale selling of U.S. bonds can also create uncertainty and volatility in financial markets. If investors perceive this move as a sign of weakening confidence in the U.S. economy or its fiscal policy, it could lead to a loss of confidence in the dollar, potentially weakening its value over time. 86+ source. 87+ source. Impact on dollar demand. China's move to sell U.S. bonds is part of a broader de-dollarization strategy, which includes increasing its gold reserves and conducting more international trade in other currencies. As China and potentially other countries reduce their reliance on the dollar, the global demand for the dollar could decrease, putting downward pressure on its value. Economic sanctions and geopolitical tensions. The ongoing geopolitical tensions and the threat of U.S. sanctions on countries like China can lead to a shift in reserve management strategies. By diversifying away from the dollar, countries aim to protect their economies from potential sanctions, which could further reduce the global demand for the dollar and weaken its value. Inflation and currency value. If the U.S. government responds to higher borrowing costs by increasing the money supply or engaging in other inflationary policies, this could erode the purchasing power of the dollar domestically and internationally. Higher inflation can lead to a depreciation of the dollar's value. Long-term economic outlook. From a long-term perspective, the U.S. economy may face several challenges. The shift away from the dollar by major economies could diminish the dollar's role as the world's primary reserve currency, reducing the U.S.'s economic leverage globally. This shift might also necessitate adjustments in U.S. fiscal and monetary policies to stabilize the economy and maintain investor confidence. Moreover, as the global financial system evolves, the U.S. may need to enhance its economic resilience by investing in technological innovation, education, and infrastructure to sustain growth and competitiveness. Policymakers may also explore new trade agreements and partnerships to mitigate the impact of reduced dollar dominance. In summary, while the immediate impact of China's bond sale could lead to higher interest rates and market volatility, the long-term implications suggest a need for strategic adjustments in U.S. economic policy. Balancing fiscal discipline with investment in future growth areas will be crucial for maintaining economic stability and global influence.